Tom, what do you see as far as the jobs numbers coming in? And do we want a strong one or a weak one? And
yeah.
What, are rates going even lower?
I don't even think it matters at this point. So for the July, should say the June jobs report, the Fed's cut in July is in the bag. Whether that's strong or weak, we're going to get that one cut. Now, if you're bullish on the U.S., you want to see that be a strong jobs number. But in terms of Fed policy for the immediate term meeting, I really don't think it has any impact.
What do you think? David?
I agree with Tom. The Fed basically promised a cut. They better deliver it. Otherwise, we're all going to be very upset about their inability to communicate clearly. One cut, but not a series of cuts. The labor market, I believe the Friday report will show the labor market remains solid and a pretty full and healthy labor market that continues, led by services. Look, what we've got going on is still the trade conflict, slow investment spending, manufacturing, global growth, and I find myself continuing to shave my earnings estimates for the S&P. We keep reducing our earnings estimates, and that's what's keeping us concerned about the equity market. But on the other side, we're continually surprised about how low interest rates are, and that supports a higher PE.
Right. So it's offset, and we've been talking about it all morning, actually, about whether the offset and the weakness in maybe margins start going down a little bit with some of these companies.
We've seen margin pressure, particularly at the industries that are exposed to trade. Look, the way I think about it is that the S&P is about 10% overvalued versus historical interest rates, 10% undervalued versus current interest rates. But I think giving credit for how low interest rates are right now is something we can only do over time to see if interest rates stay this low and earnings can prove resilient despite those interest rates.
Well, there's no reason to think that multiples would contract in a period where the Fed is, people have pointed out it's not the one cut. It's that when you're in a cutting mode, there's usually two or three or four.
Well, I don't expect a rapid multiple compression.
Why would it compress at all? Why wouldn't it continue to expand if we go?
We continue to have deceleration in the economy.
I mean, how much is negative over? Sovereigns are actually negative right now, at least. I mean, we're the best game in town in terms of yield.
The only scenario I could see where you see compression in the multiple is that you see a spontaneous pickup in inflation. And particularly one that seems like it's got some staying power, which really, for the time being, that's really on no one's radar. So I don't see a compression in the multiples right now.
Yeah. So David, we always ask you about your S&P targets.
Yeah.
And so what do you, weren't you 2950 or something
For
like that?
the end of the year, and we're above that right now. I think immediate fair value is more like 2850, given that we've got a bunch of challenges to get through, including a challenging second quarter earnings season. Like I said, I think the S&P is a good 5 to 10% overvalued. It wasn't the worst possible outcome imaginable at the G20, but it was exactly as we expected. The existing tariffs remain intact. I don't expect them to be dropped anytime soon, and companies are going to cut their earnings estimates because of it. So
if we see you in 3 months and we're over 3,000 on the S&P, how are you going to say, yeah, what would have to change for you to go?
I have been doing this for well over 15 years, and what drives my earnings, my S&P targets are my earnings estimates and our fair return estimate on S&P long-term returns, basically driven by interest rates. Now, interest rates are lower than where I expected them to be, and if they can stay this low, we will think about a higher PE, but I think it's
well, I don't see
rush toward it.
If I were listening to you, I don't know if I'd sell stocks, but I wouldn't be buying stocks.
Yeah, look,
so we're 20, we're above 29.50 right now.
What we're actually doing is
you don't think we'll make any gains between now? You actually think we're going to be lower?
We're going down 5-10%, and then we'll finish the year kind of where we are right now. But if it really is about interest rates being the reason why the market is where it is, with potential further upside from here, then let's make it simple. Go buy all the bond substitutes, REITs, utilities, go buy the secular growth companies who are going to have earnings growth really regardless of the interest rate in the macro environment, communications, healthcare companies, and really selectively in tech.
So could Europe recover, which would, or is it that's not on the horizon? Because I mean, Europe takes us down as far as interest rates to some extent. Could they take us back up?
Well, yes, and I'd say the sensitivity to European yields or German yields is actually more on the upside. That is, when German yields rise, you get more sensitivity on the U.S. markets from an upside uptick in German yields than you do on the downturn. And that's because it's something when we were on the show back in the fall, we were talking about hedging costs. Hedging costs are still a major factor that tend to essentially keep flows from Europe from going into the U.S. And so, as you see, when you see those hedging costs come down, you'll eventually see those flows come back into the U.S. But the opposite is true. When German yields push higher, you see flows out of the U.S.